And joining me now in studio for a closer look at the day's market moves is Reko Nare from Anchor Capital. Reko, thanks so much for your time this afternoon. Now, traders seem to be leaning more into riskier assets with gold pulling back, and we are seeing that reflected on the JSE. A mixed picture today, but continuing what we saw yesterday, where resources closed 7% lower, and that of course impacting the all share. Same picture playing out today, resources down 4%, and that also weighing on the JSE all share. Would you say this is just a healthy pullback, investors starting to, take some profits as well?
Darling, thanks so much for having me. It's great to be on the show, and hello to your viewers. I'd probably say that, look, what we're seeing happening within the markets is largely healthy. You will think that both within global markets and within our own local market, we've had a strong first half of 2025 as well as a strong third quarter of 2025. So I think by and large, you're seeing traders begin to really exercise a lot of caution in the way that they trade. You don't want to lose a lot of the gains that you've made so far year to date. So you are seeing some traders just beginning to trim some positions. I think that's what we were doing yesterday specifically, just beginning to trim some positions. And I think, well, what you're seeing playing out, you remember that by and large, the South African story has been that of gold, that of platinum, and that of copper. And then, of course, that along with the rand hedges. But by and large, you are seeing traders begin to take some profit, begin to exercise some caution, beginning to build some defense into the fourth quarter of 2025.
And you're just seeing it, on the JSE, it's really evident that those gold players, the platinum players, the rand hedges are what's really boosting the JSE, because now with, the pause in gold prices in particular, you're seeing that, being sifted out, and you actually get to see the real picture of what's playing out where, we're in a low growth environment, and those SA Inc. stocks not getting much support.
Yeah, Darling, you made some really good points there. I think on the gold side, even with the 5%, 7% pullback that we saw within gold yesterday, and you are beginning to see a little bit of recovery today.
Yeah.
But I will say, gold is still up 50% year to date. And you've, of course, seen our gold miners, I think the likes of Harmony, up in the hundreds year to date. But you touched on a very important point there, and that's the fact that we need to see growth within the SA Inc. Picture. I think, look, I think a tailwind will be us getting off the grey list. That's expected to be announced on Friday. So I think that might be positive. It's likely to be positive for the as far as sentiment is concerned. But we need to see growth play through. You're seeing that when you look at SA Inc. at its core, when you look at the apparel retailers really struggling. You remember that the Fushini Group yesterday released a trading statement that basically said that they expect HEPS to come in, sort of negative 90%, 90% knock to its HEPS numbers. And that's largely on the back of the fact that you've got a low growth environment.
Yeah.
So we need to see growth begin to filter through in order for the overall picture within the SA Inc. basket to look a lot more attractive for both local investors and for foreign investors.
Of course, that TFG update speaking to consumer sentiment and consumers really spending their money on necessities. All right. Sticking with that in a consumer picture, we also have inflation prints in focus this week. US out with inflation numbers on Friday. Today, though, we have local inflation as well as inflation data out of the UK. Let's start with the UK. Inflation holding steady at 3.8% for the third consecutive month, right? Still well above that 2% target, but we're hearing the words prices have peaked, and so we could possibly see the Bank of England reducing rates next month. Where do you stand when it comes to that, considering that the UK is also dealing with that low growth environment, and we also have Reeves delivering that budget next month?
Darling, what I would say when we look at sort of the overall growth picture and the overall inflation picture, specifically the inflation picture as we zoom into it. Of course, the Trump tariffs and the impact of the Trump tariffs, the question for investors, and that's just not only for the UK, I think for the UK, for the US, even for South Africa, is have we seen the full impact of the Trump tariffs? I think Morgan Stanley did a recent research report along with the Fed of Richmond, and basically what they said is that by and large, businesses have consumed or rather eaten that tariff and have not passed that through to the end user or the end consumer. But what they have said is that they're going forward into the next kind of fourth quarter, into the first half of 2026, businesses by and large survey that they do likely see themselves pass on that inflation to consumers. So I think, look, I will say that, look, the expectation is that, was that we would see in the third quarter of 2025, and this is globally, that we would see that tariff impulse begin to kind of filter through into sort of the inflation numbers, which we haven't seen by and large.
Yeah.
But look, the expectation, just because that it's been avoided doesn't mean that it's not sitting in the horizon. So I think that's probably what I'm looking at when I think about the overall inflation picture out of developed markets as well as emerging markets as a whole.
And it'll be interesting to see how that plays out in earnings season, particularly when it comes to those US retailers, because I think in the last season we heard from Walmart saying that they're actually starting to stomach those costs that come with the tariffs that we've been seeing in play. Let's move over to inflation here at home. You've talked inflation broadly, but I want to hone in on the SARB's next move, right? Inflation, yes, ticking higher to 3.4%, but marginally so and really in line with expectations, right? And when you talk to many economists, many think that we're at the end of the 2025 rate cycle, and we'll probably start seeing rates maybe being decreased again later into 2026, early 2027. But, right, with now the picture changing in the US, how much of an influence could that then have on the SARB's next move, as we are in an easing cycle on that front?
Toleng, I mean, even if we look at the nature of our inflation print that came out this morning, like by and large, what did you see? So 3.4%, one would largely say that that's in line with what was expected. It's still very much in line with the SARB's inflation band, or the old inflation band, the 3 to 6%. So I think, yeah, look, by and large, there is justification for rates coming lower. And I think by and large, any of my colleagues that you speak to would point to that, would point to the fact that, look, there's nothing around the nature of inflation currently that would point to the SARB not reducing rates at the next two meetings. But I think, look, you have this, in between the different categories and the different inflationary pressures that are re-emerging or coming through. I think this time around it was specifically transport and restaurants and accommodation that saw inflation spiking, while food and alcohol, which were exactly the same categories that rose in the last inflation print, kind of softening. So I think, look, there is this passing of the baton, but when you look at a month-on-month run rate of about 0.1, 0.2%, I think, look, there is justifications to see rates lower. But I think, we just continue to look at the SARB, and of course you've got when we look offshore and we look at the global markets, we've got the US announcing its CPI number at the end of the week. But by and large, look, I want to say that, look, our SARB has continued to say that they are dependent on the data, as most central banks would say. But of course, look, you've got to just see through it, and you've got to see, kind of give them the chance that they have and the mandate that they have to keep prices abated here within South Africa. But what we will continue to stress is the fact that, our issues are not the same as in the US. We've got a low growth environment, which the US, even with everything that's going on within the US, is not struggling from. So I think that's why you continue to get motivation from a lot of asset managers, a lot of economists, to see that repo rate come lower.
All right. And quickly, before we head over to clips, Famous Brands out with results today. They've also pointed to lower inflation, right? And that's what's sort of boosting its cautiously optimistic outlook. Outlook aside, those numbers out as well. HEPS up 8%. Of course, I guess they restaurants, they brands on the more affordable side, and that, of course, boosting, I guess, the overall performance as well. What's been interesting, though, is how, I think a few months ago, Famous Brands CEO Darren Hill highlighted that retailers are also starting to eat their market share with those ready-to-make meals, and of course with the consumer being a bit more cash conscious.
What I will say, I think it's a fairly well-run business. I think what you saw on top of the HEPS number that you just highlighted, you saw revenue up 5.6%. South Africa continues to be the core part of the business that continues to tick along. I think the only grey part for us when we look at those numbers will probably be the Asia, Middle East, European numbers and the UK numbers. Those look quite soft from us. So if you think about us from an investment perspective, think about the value at a 9 times forward PE, not very demanding. It's about 18% below its sort of average, so that could scream value. But I think currently, we probably would like to see that a little bit of an improvement within that Asia, Middle East, Europe, and UK business.
All right, let's hit pause on the conversation. Before we get to your stock pick, let's take a moment to touch on which counters your industry peers are watching closely.
I'm going for Truworths, which was down 3% today. And the reason, I'll give you 2 good reasons. The first is that the South African long bond yield has rallied from 11% to under 9% over the last 12 months. That should be the inverse of the Truworths PE. The Truworths PE should have gone up, and actually it's gone down, let's say from 9 or 10 to 7. So the share is extremely cheap, despite the fact that the long bond has moved in the opposite direction. And then I would say management. I think that Michael Mark is among the most trustworthy of all the chief executives on the JSE. I don't think that he's immune to what goes on around him. I mean, we know the economy is not growing, but at the end of the day, one of the most important things we believe at Allweather is you must invest with management that you trust. And if you don't trust the jockey, just don't do it. And I think he's a very trustworthy person.
LVMH, luxury. I've been going on about Richmond for a while and thinking that's about. I think LVMH in the same sector also has potential. Unlike Richmond, it's got a broader product base, from handbags down to sparkling wine, or as my wife said, baubles and bags and bubbles. So in that sense, they are not as dependent on one specific sector like Richmond, for example. Plus, the company itself has been under pressure ever since COVID, basically. But we are seeing signs of a turnaround in revenue. And as I've said, free cash flow depends on 3 things: margins, revenue, and how you handle your debtors and creditors book. So if we can get a revenue increase, and I think that's what it looks like, as if you've got a turnaround in that, their margins are fine.
So bubbles and fashion with LVMH and fashion again with Truworths. What are your thoughts on those counters?
I'm going to start with the global bubbles,
yes,
and just kind of stick to LVMH. We are global investors, so I think we've got a lot more coverage when it comes to looking at businesses like LVMH. But I think I will agree. Look, it's a company that we have held. If I think about that last trading update for the 3rd quarter, I think revenue was up 1%. But what was positive was the fact that you did see the China business beginning to print positive. You will remember that this is a business that's been like a drag on the overall group sort of over the last 2 or so years. So it was good to see kind of China, all divisions performing well, and China also seeing signs of recovery there. But what I will say is the fact that, at a 25 times forward, it's not necessarily like the cheapest of businesses. And then analysts are cautioning the fact that you've got some margin pressure coming through and still muted volume growth. So I think if we do see that, then I think it's a great business and a great business to hold. So I think LVMH, I'll just kind of stick to that one for today.
All right, then let's get to your stock pick. Where are you seeing opportunity at the moment?
Yeah, Ntoling, so it is one that I've spoken about before. I think every time that I've been on the show, I've spoken about one share that starts with an A. So this time I'm going to go with Afrimat.
All right.
So
this is local.
There you go. So if I think about, just the last set of results that we got, the expectation is that you'll see headline earnings rising by about 90 to 95%, largely driven by 145% increase in domestic iron ore volumes. So iron ore and that iron ore business continues to push that story positive for us. So for me, it's a pure iron ore turnaround story. Of course, you've got cement and anthracite business that continue to kind of sort of be a drag, but we are seeing that cement business begin to turn positive. And yeah, I think by and large, what you're buying here is you're buying a turnaround story for a growth-orientated investor. So that's AFT. on the JSE.
All right, Afromat, one to look out for. Reko, thanks so much for your time and coming into studio to chat with us this afternoon. That was Reko Nare from Anchor Capital.